In this video, I'm going to show you the journal entry to record a sale. But first, we have to answer 3 questions. Was it a credit sale or was it a cash sale? If it was a credit sale, we're going to need to record accounts receivable. And second, did you sell goods or did you sell services? If you sold goods, we're going to need to reduce the inventory account and record cost of goods sold. And third, did you collect sales tax? If so, we're going to need to record sales tax liability. So next, let's do 3 different examples so you can see how each of these factors comes into play. And in our first example, we'll assume that a company is selling goods on credit and that there's no sales tax involved. Okay, so a company sells gluten-free diet water for $150 on credit, and the cost of the product to the company had been $10. So our journal entry, first we're going to record the sale. Okay, and we're going to debit accounts receivable for $150, and then we're going to credit sales revenue for $150. Okay, so this is recording our sale, but then also we need to reduce the inventory account because we no longer have that diet water. We don't have the inventory on hand anymore, so we're going to record an expense, cost of goods sold, for $10, and then credit inventory to reduce the inventory asset account. Now, if you're wondering, hey, couldn't we have listed the debits first, like debit accounts receivable and debit cost of goods sold, followed by the 2 credits of sales revenue and inventory? Yes, if you want, you could list all the debits first and then list all the credits second. And that's very common in accounting practice. That's how most accountants do it. I just did it this way so you could see the 2 different parts of the transaction. We're recording the sale here, and because it's a credit sale, we're debiting accounts receivable instead of the cash account. When we later collect the cash, we'll debit the cash account and credit the accounts receivable. Okay, but right now, recording the sale, we're debiting a receivable, crediting sales revenue, and then we are debiting cost of goods sold and crediting inventory to get the inventory off our books. Now, in the second example, I'm just going to make a change where now we're going to be selling the goods for cash, so we're not going to have account receivable involved, and then we're also going to have a sales tax. So let's say a company sells gluten-free diet water, and again, we'll assume the price is $150 and the cost of the product was $10, similar to example 1. Okay, but this time they're also going to collect $6 of sales tax. So the company is going to debit the cash account for the $150 that it sold the product for, plus the $6 of sales tax. So the company's receiving not just the cost of the product, right? They sold the product to the customer for $150, but then they also had to collect $6 of sales tax on top of that. So the company's actually receiving cash of $156. Now, the sales revenue component of that is just $150. That was the price of the product. So to make our debits equal our credits, we have to have a plug, and that is a $6 credit, and we will call that sales tax payable. Okay, it's a payable account because the company is going to have to turn over that $6 at some point in the future to the government. So the company has collected that sales tax on behalf of the government. So again, we didn't debit accounts receivable here because we're receiving the cash immediately, so there is no receivable, but we're still recording sales revenue, and then now we have this sales tax payable liability account. Okay, so it's a liability that would show up on the company's balance sheet. Next, we have to reduce the inventory account because, again, we sold goods and the cost of the product was $10. So, again, we're going to debit cost of goods sold for $10 and then credit inventory. Okay, so this credit to inventory is going to reduce the inventory asset account, and the $10 debit to cost of goods sold, that's an expense, right? Cost of goods sold is an expense that goes on the income statement. And in our third example, now we're going to assume that we sell services. Okay, we sell services instead of a product. So the company provides a consulting service for $150 cash. So because we're providing a service, we're not going to have this journal entry where we debit cost of goods sold and then we credit inventory. We don't have to do that entry this time because there is no physical product. So we don't have to worry about that. All we're going to do is debit the cash account for $150, and then we will credit the sales revenue account, or if you want to call it service revenue to distinguish the fact, let's say the company sells physical products and then also services. So some companies will call that service revenue in their chart of accounts. But either way, we are going to credit a sales revenue or service revenue account for $150. So all we had to do was record the sale because we didn't have any inventory we needed to move off the books. And in this example, we had assumed there'd be no sales tax. So it's pretty simple, just debit cash and credit sales revenue. Now, if we had changed this where we said that they had sold the services on credit, on account, right, and it wasn't for cash, then we just make a little change. We would just debit accounts receivable for $150 and then credit sales revenue or service revenue for $150.